welcome to a brand new show of Market Makers. Now, these are interesting times for Indian markets. The bulls would argue that the worst of the economic print is behind us. Indian economy is healing and directionally we are going in the right direction. But the bears are still insisting that global cues are difficult to dissect. Crude prices are at $50 per barrel and valuation risk in this market now is very, very high. So how should one navigate in this kind of a market environment? 2 years ago, this market was dominated by hope. Now, some degree of reality check has kicked in. So to understand market dynamics, talk about big themes and mega trends, I have with me Nilesh Shah and Vision. Nilesh, it's been a while, but fantastic to have you back on ET now. Depending on your market opinion, I guess you can argue. If you're bullish, you would say the economy is headed in the right direction. If you're bearish, you would say economy may be headed in the right direction, but valuations certainly are much ahead of themselves.
Yeah, I think that's pretty well put, Nikunj. I kind of agree. I think the economy, while there's a debate whether the economy is shaping up or not, but we clearly believe that the economy is shaping up very well. The economy is slated to do really well over the next few years. I think a lot of initiatives which this government has undertaken over the last couple of years will begin to kind of manifest themselves over the next 2 or 3 years. And I think the good news is that whatever the government has done so far in India over the last 2 years, it's not done keeping the short term in mind. It's more kind of an overhaul. It's more about saying, how will this benefit me for the next several years or the next several decades? And I think that makes this economy in a much, much better shape than what it was earlier. Fiscal consolidation is no longer a threat. Fiscal consolidation now is a given, and I think that's really what the government's top priority has been. And many of the other initiatives, beyond agriculture, beyond the rural economy, beyond the banking side, technology side, I think all of these direct benefit transfer, I think a lot of good things have really happened in India over the last 2 years, which I think make Indian economy and India as an investment destination qualitatively a lot better for the next several years.
Any market has two risks. One is the valuation risk, second is the earning risk. I get a sense that the earning risk is behind us because directionally we are headed in the right direction. But what about the valuation risk? And I'm not only looking at the Nifty, 15, 16 times, Nifty is looking okay, but mid-cap stocks are trading at valuations which I've never seen them trade before.
Yes, I think the mid-cap space has witnessed a tremendous amount of re-rating. A lot of individual companies have done exceptionally well over the last many years. And despite the devil's advocate view that some of the companies may not be able to sustain their revenue momentum or margins or profitability, I think a lot of companies have been, but those are of course companies which are doing business in a very exceptional manner. They've carved out their niches and they are basically doing business in their own way and excelling there. But of course, you're right, valuations are kind of reached sky high in a lot of those areas. So one needs to be very, very careful about that. I think in the large cap space, clearly I think size itself is becoming a constraint for a lot of the large cap or the mega cap names. It is going to take them time to kind of move the needle. A lot of them of course are also positioned to kind of for a global revival, but that's something which is yet eluding us and it's not yet happening, and they are exposed to those kind of risks. Some of the larger companies are also exposed to this whole commodity risk. I mean, and again, commodity prices are kind of oscillating or gyrating, but that itself is a risk whichever way you look at it. Low commodity prices are also a risk and high commodity prices also are a risk. So I think the bottom line is that I think global volatility is in a way casting some kind of a shadow on the earnings outlook for some of the larger companies, and I think that's a real risk which can also kind of translate into some kind of a valuation risk because we're trading probably at about 16 to 18 times, so which you could probably say is yes, it's in a fair value zone, but we've also seen that a lot of value emerges when markets slip below that range. More like the 14 to 16 times, that's when really a lot of value emerges in the large cap space, and that's the scenario one has to look out for.
So an old timer would say closer to 21,000, 22,000 be a buyer if the index goes there?
Oh, I mean at those kind of levels, which is we're talking about 20% lower from here. Oh yeah, absolutely. I think at those kind of levels, the valuations would look very, very compelling. I don't think at those kind of valuation range, historically one has gone wrong. If you invest there and then wait out for the next few years, the chance, so as Buffett would put it, the margin of safety is very, very high. when you really kind of put it out, when you look at that kind of a range. So number one is that. And number two is, over a few years, earnings will also play out for individual companies, because that is really where the test of the management comes in, that in a bad environment, how do you reshape yourself to deliver and to excel. And so if the markets were to come down to those kind of levels, I think that would be a fantastic opportunity.
So how are you investing in this kind of fund market? You're a mid-cap specialist. Mid-cap is where bulk of the fun and excitement has happened, but valuations are not that attractive. So is this a very hard market for you to invest?
Not really, because I think the way we look at it is that we look at individual companies, and I'd like to say that yes, there are pockets of exuberance in the mid-cap space, but then there are pockets where valuations are fair or valuations still are kind of low. The other big opportunity, according to me, over the years in the mid-cap space has always been the potential for re-rating. So you could start out and play out your investment thesis or write it down saying, this is here at 13, 14 times. But what you really see over a period of 3, 4, 5 years or even longer is that same 13, 14 times goes to 20, 25 times. So for over a 3 to 5 year horizon, if you see the P multiple, for example, say double, and then if you see earnings growing at say 20%, I think put together, you kind of end up having market beating returns or a possibility of having market beating returns. So one is that. Two is, I think while one looks at mid cap, but really the top down approach also helps you, because a lot of themes emerge from a top down perspective. A top down view really helps you to look at both opportunities. It helps you to look at risks both ways, because at the individual company level, risks may not manifest, but if you kind of have a top-down view, it helps you to also identify risks and be very cognizant or be aware of what kind of risks might play out. So I think it's a very interesting space where you look at top-down to look at both opportunities and risk, and you look bottom-up to see that within this bottom-up approach, which are those individual companies which are best positioned for you to really ride on that top-down theme.
But by and large, in the portfolios you manage, you're fully invested.
These are portfolio construction is a process, so it depends upon how old a portfolio is.
No, but you're not taking a serious cash call is what I'm trying to
understand.
We
don't take cash calls. What we definitely try and look is that whenever there is an individual portfolio, and if we are investing into an individual company, we just try and figure out that at these kind of valuations, does investing at these kind of prices help? We would not simply invest into a company just because it's part of a model portfolio, and so even if it's trading at ridiculously high P multiple, we would not invest because we're saying is that it's part of a model portfolio. We definitely take those individual portfolio and individual stock specific, saying that okay, fine, over the next 3 to 5 years, can this individual position deliver the alpha over the long term? That's basically the kind of strategy that we adopt.
So again, without getting into individual stocks, tell me the basic fabric of your portfolio. What are the top 3 themes you're chasing?
So it's a very, in a way, it's pretty, I'd say that yes, we run a concentrated portfolio, but we have, if you look at each one of those individual positions, they're very divergent in terms of the opportunities that we are chasing in a way. I mean, they're really not connected, they're not really correlated. So it's very diverse. We have positions which are in technology, we have positions which are in consumer, we have positions which are in engineering space, we have positions which are in real estate, for example. So I think these are all very independent kind of themes, but I think within each one of them, we have strong reasons why we kind of own them. So for example, in the technology space, so one of the positions that we've been owning now for a while is basically which is around providing technology-led design services. The other position is basically a company which is a very specialized provider, which was earlier focusing on SMAC and has now shifted gears to IoT, for example.
So you like these niche IT companies?
Yeah, I think so, because I think in the conventional technology business, size, you need to have a size. Okay, so that's honestly a very linear, people-oriented model, that you hire so many thousand people, and therefore you basically create capacity and you get revenues, and therefore you get growth. But I think that model itself is at risk. And if you look at some of the things which are emerging, be it areas like artificial intelligence or design thinking, or for that matter IoT itself, is the conventional application maintenance and development business, how how will that kind of a space grow? There are serious questions or doubts on that. Whereas a provider of specialized services brings his domain knowledge, can partner with the right set of technology players. If he's able to do that, then one can either have relatively higher growth, industry beating growth, or one can basically have non-linear growth. And that's, I think, really the fun in the technology side, and that's clearly where the big opportunity is.
All the fun and excitement within the within the financial space rather currently is with the NBFC space. Bajaj Finance north of 7,000, Cholamandal nearing 1,000 rupees. PSU banks are down in the dumps. NBFCs top of the ladder. Private banks are somewhere in the middle. How would you like to dissect the financial space right now?
I clearly believe that's probably one of the most vibrant opportunities that India has ever had. And if you really look at how is this space evolved, over the last 10 to 20 years, India has evolved to become a services-oriented economy, where millions of people have got jobs, be in IT services or some of the other sectors. And it's those very same set of people who've really become customers for NBFCs or for some of the private sector banks. So for example, if somebody didn't have earlier a job and he's kind of getting into a job and is drawing 50,000-70,000 rupees a month, he becomes a customer for a home, for a mortgage lender. He becomes a customer for somebody who's financing two-wheelers, or he becomes a customer not just for Maruti, for example, but also for basically somebody who's willing to give a loan to that customer to buy a Maruti car. And that's really where the growth has come in. So I think whether it is basically the actual consumer or consumer durable companies, but it's also for these lenders that this has emerged as a segment. I think probably for the next 10, 20 years, this whole DBT, direct benefit transfer, is going to be a very powerful phenomena, where you're going to see millions basically getting cash flows on very regular intervals through the subsidy payments. And this will over a period of time has the potential to become really large. So that is on one hand. On the other hand, we have the microfinance institutions, MFIs, who are basically also lending to virtually these same set of people. And then some of these MFIs will convert into small finance banks. Yeah. So if you really combine these three things, DBTs, the expertise you've developed in MFIs, and your conversion to a small finance bank, I think it can become a very, very powerful phenomena. Because what happens is with DBT, the end consumer will basically get more cash flows with the help of which he probably can even borrow more. Or let me put it the other way, that the MFI can lend him even more. So to that extent, for the MFIs, the opportunity to do business is even bigger. And then when the same MFI converts itself into a small finance bank and is able to build a successful liability franchise, the cost of funding can come down, and over a period of time, the MFI's dependence on some of the conventional banks for refinancing also comes down. So in a way, you could probably see a scenario where over the years, you can do more business with more number of customers with spreads which are as good, or spreads which, where spreads are sustainable, let me put it this way. And I think that is a very, very powerful kind of a phenomenon. So what we have seen in urban India, you would probably see that over the next many years in either rural India, you could call it, or you could call that Bharat, or you could call that as bottom of the pyramid opportunity.
So the point you're making is that the way private banks dominated Indian financial sector between 2000 and 2010, MFIs may dominate Indian financial sector between 2015 and 2025.
Absolutely. I mean, I think they have a huge tailwind there.
Can they be part of the Nifty?
I wouldn't be surprised. Let me put it this way, that I wouldn't be surprised that they can. And I think if you really look at it, I don't have that exact data, but you really look at some of the private sector banks which are today part of the Nifty. How many of them were part of the Nifty maybe 10 years back or 20 years back?
Bank, a classic case. HDFC Bank, another classic case. So that's
right.
A great point. As a mega trend, if somebody has to bet on a theme, it has to be the MFIs which are getting converted into banks. And once they get converted into banks or small banks, the trajectory and the landscape will change for them completely.
Absolutely. So one is that, or two is you look at some of the existing banks. So if you really look at it, both IDFC Bank and Bandhan Bank, for example, they are not small finance banks. They in a way, they've got license as universal banks, but they clearly have that as the core of their strategy. Bandhan in a complete manner and IDFC Bank in a very partial manner. And a caveat here that we own IDFC Bank. So that's the disclaimer, but I'm just saying is that so either we look at some of these banks or we look at some of these MFIs which will convert into a small finance bank. I think there's a very, very big opportunity out there. And finally, the ones who will survive in this whole space, I think have tremendous potential for a re-rating. So if you look at it 10 years back, or not 20, but 15 years back, many entities got licenses to set up private banks. But finally, 2, 3, 4 have remained, and you see the kind of wealth creation these 2, 3, 4 private banks have created. Similarly, NBFCs in the 90s, there were NBFCs by the dozens, and today there are a handful of NBFCs.
They have survived, and they will only go bigger and bigger.
That's right.
Since that happened to the dot-com bust. I mean, Amazon has survived, and look at where Amazon stands now.
That's right.
Let's talk about pharmaceuticals. In the portfolios you manage, you don't have a very large exposure to pharma stocks.
That's right.
That strategy so far has worked for you.
That's right.
But now is it time to revisit that strategy? Because pharma is where there is distress. Pharma is where there is a lot of disbelief. Pharma is where there is a lot of stress also.
Yeah, I think, we're very proactively looking at that space because, in some of the companies, the prices have come off by about 50%.
These are great businesses, 30%, 25% return on equity, zero debt.
That's right. And honestly, I think right now, as a sector in the marketplace, it is witnessing a lot of rough weather. That's the last space you really want to be in. I'm saying from a very short-term perspective. But we clearly believe that some of the pharmaceutical companies are building world-class businesses. Some of these companies have gone through the learning curve. Some of these companies have had headwinds in terms of regulatory issues. But we believe that some of them, not some of them, but maybe just even a few of them, would be able to cross these hurdles and become bigger and better and maybe even bolder. And I think that's clearly when the potential for re-rating can happen. So some of these companies can go through rough weather. They may kind of not deliver returns for 2-3 years. But I think post that, I think it just takes probably 2-3 quarters or maybe just a couple of years for the returns to basically come in. So I think we're not in a hurry or we're not in a rush to kind of go out there and invest in the space. But it's one space where we're definitely excited about for the long term and are evaluating that space in a very, very constructive manner.
And pharma has been very close to your heart. I mean, your previous avatar, I think, was the first one who identified the potential of Indian pharma in 2001, 2002.
Yeah, I think, yes, the potential is large. And I think if there is one sector who's really been able to kind of acquire some bit of dominance on a global scale, on a global platform in some of the most regulated markets, I think if one sector really stands out, I think it's pharma.
So stick to large cap, even if you have to buy pharma.
I think large cap, and I think even some of the smaller ones, which are small today, but I think are building an impressive business model and can probably grow at a faster pace. So of course, this whole price correction has made the large caps also very attractive from a long-term perspective. But I think along with that, you need to kind of proactively look at some of the smaller companies, some of the mid-sized companies, which have got a unique business model and where valuations make sense. I think so I think it's probably you can have a combined approach as far as this sector goes.
Nilesh, I've been wanting to ask you this question for a while now. The great wealth is always created when you focus on not which are the top 50 companies, but which are the next 100 companies, which could be the next great 50 companies. So where is that pool? Where are you hunting? Where are companies which are mediocre in size right now, mediocre in market cap, but they have potential to scale up or potential to become large?
I think that's a very, very interesting question. And I think the way I see it, and if I were to take a very long-term horizon, I see two very divergent set of opportunities. One is which is very global and can be very widespread, and the other is basically more local. I think on the global side, I genuinely believe that IoT, for example, is a huge opportunity. Okay, somebody like a GE, for example, is betting huge on IoT. That's just an example, and they're talking of digitizing even, in fact, all their factories and all of that, and getting productivity gains of about $1 billion by 2020.
I've been told by 2020, 20 billion devices would be talking to each other.
Absolutely. So you have a situation where you have objects or things getting connected to devices, connecting to sensors, and with that, the data which gets generated is connected to your mobile smartphones, and that in turn gets stored on the cloud, and using cloud computing, you analyze that data, take out actionable data, and then use it to make decisions which can make you more efficient and make you more productive.
And G's been right in calling the technology.
That's
the
right.
first one who called the call center opportunity.
That's right. And within that, the opportunity is estimated to be $1.8 trillion, right? That's the kind of estimate, global opportunity for IoT over the next several years. So if you can find out any company which can really be a play on that, I think that can be a very, very interesting opportunity over the next maybe 5-10 years. So that's one. Two is on the local side, as I was mentioning, is that I think, this whole opportunity in agri-rural Bharat, combine that with regulatory changes in the banking system, which is the whole small finance banks, MFIs, you put all of that together, and the kind of ecosystem that it can create in India, in Bharat, on the ground level, in villages, in small towns, I think the kind of ecosystem which it can create, I think is going to be tremendous. So, there could be many candidates for huge wealth creators, but I think if there were two themes which I can look at currently over the next 5 to 10 years, I believe that these two could be very powerful and very enduring themes, in which I'd be very surprised that if 10 years down the line, if there are 10 wealth creators, I'd be very surprised if at least 2 are not from these kind of themes which we see currently.
So if I look at the current composition of the Nifty or the Sensex, 40% broadly, plus minus 1% or 2% is broadly financials. Then you got IT, pharma and consumer. What could be the shape of Nifty in 2020?
Wow, I think I'd probably still think that the constitution would broadly remain the same from, say, the allocations, because I think both these opportunities will only grow bigger. What could change is the players there. So if for example, say 5 years back, if there were more, say, state-owned banks in the Nifty, maybe there's a case that, that number could fall for state-owned banks and you could have more private banks come in there. Similarly, within technology, pharma, consumer, it's quite possible that the existing incumbents, a couple of them could get displaced and make way for some of the newer guys. So I think IT, consumer, pharma, banks, I still think, 2020, 2025, they'd still be around. But maybe the names could change. And I think that's really where the big opportunity is, that, you are able to kind of really identify some of these big names and see the small getting bigger and the bigger getting really mega. And that's really the kind of value discovery cycle that one has to basically be able to ride over the next several years.
The art of investing is all about identifying good companies which can become great companies.
Absolutely. That's right. But I think the opportunity in India is tremendous. India is the land of entrepreneurs. India is the land of a lot of companies which are small but are becoming big. And I think if one can, do a proper process out there, do your research well and invest in them with a long-term horizon and carry a high degree of conviction, I think probably that's a pretty strong alpha generation strategy.
Compliance does not permit you to talk stocks, but it does not stop you from sharing returns. So what's been your fund return in the last 5 years?
So in the last 5.5 years, both the Sensex and the Midcap index on a cumulative basis are up about 30-35%, versus that we are up about 115%. On an annualized basis, both these indices are up about 5%. We are up 15% post all fees expenses. So that's the kind of alpha generation that we have been able to do.
Then you still feel that such a strong alpha generation or index beating returns are here to stay in a market like India, which is getting mature, which is getting very discovered.
Right.
It's hard to identify ideas now, because you pick up a good company and there are 5 reports already out on that company before you make your mind to invest in it.
So that's a continuous, in a way, a constraint or a handicap that you can consistently face. That's a continuous imperative, what Buffett calls as the institutional imperative. But that's really where you need to step back and say that, at this particular price, is there enough value for me in the particular company to invest, where I can not only have a margin of safety, but I can also deliver the kind of alpha which I'm endeavoring to deliver. So that's really the decision which the investment manager has to take, and that's what investing and value investing is all about.
Nilesh, fantastic to have you back, and thank you for joining us.
Thank you, Nikunj.
That's it on this edition of Market Makers. I'm Nikunj Dalmia signing off. Thank you for tuning in.
Find us on Facebook at facebook.com/ETNow and don't forget to click the like button. You can also follow us on Twitter at ETNowLive. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/user/ETNow.